All right, welcome. Thank you for being here. Today's session is called Learn How to Protect Your Retirement in a Down Market. This is for homeowners 62 and over. So if you've been watching the market and thinking, I can't afford another big drop, I totally get it. You did the right things, you saved. So this part can feel scary. So my goal today is simple. I want to give you facts and options so that you can decide what's best for you and your family. And because most of you are homeowners, we're going to talk about something a lot of retirees overlook, which is home equity. Not as a last resort, not as something to be afraid of, but as part of retirement planning. So you have options before you need them. But let me tell you a little bit about myself first. My name is Michelle Albon. I'm a certified mortgage advisor, certified reverse mortgage specialist, certified Medicaid planner. I have been in finance for over 25 years, initially as a estate planning paralegal, doing Medicaid applications, asset protection, and real estate, plus estates. I worked at a nursing home as director of admission and Medicaid, so I was able to determine eligibility for insurances, Medicaid, private pay, coordinate discharges and entrances into the facility. Then I took everything that I learned from the previous experience and started my own business where I did consulting and helped families doing all the same things. So at crisis time, when they either ran out of money or weren't prepared at all, I would help them coordinate care, asset protection for Medicaid purposes, Medicaid planning, Medicaid applications, making sure that they had a safe discharge from the nursing home, make sure they had the care or into an assisted living facility as needed. So I've seen firsthand hundreds and hundreds of people at a stage in their life that they didn't expect, that they did save for, but life happens and money sometimes just doesn't last as long as you want it to. So our roadmap today is we'll start talking about what's happening in the market and why it feels different when you're in retirement. We'll talk about the hidden risk retirees face, like inflation, market drops, and something also called bad timing. After that, we're going to spend time on home equity because for many retirees, one of the biggest assets you have is home equity and your home. Then we'll talk about the tool that is misunderstood, which is called a retirement mortgage or also known as a reverse mortgage. So before you shut your ears or get out of this Zoom call, listen and we can discuss it a little bit further. I'll keep it very simple. We'll keep it clear, separate myths from truths. And at the end, we'll get some simple next steps to see how this would look for you. So let's set the stage a little bit. You are not the only one feeling like this. If you've been feeling unsettled lately, you're definitely not alone. A lot of good, responsible people feel nervous right now. Market swings can make retirement feel very uncertain because you're living off your plan now. You're on a fixed income. Inflation makes it worse because it feels like everything costs more. Many retirees worry about the same thing. Am I going to run out of money? Most people I talk to really aren't trying to be rich. They just want stability and independence, and they work so hard for what they have, they want to protect it. So that's what today is about. So these are the three biggest pressures that hit retirees. They are inflation, like we discussed, which is groceries, utilities, insurance, healthcare, all of that adds up. Second are market drops. Even in the best economy, we do have ups and downs in our economy and our markets. Third is longevity. Like I said before, there are so many people that are living longer than expected, which is truly a blessing. But it means even if you're healthy, your money has to stretch longer. And that's not even including any rehab or healthcare that you may need along the way. So when this pressure hits, retirees often feel like, I did what I was supposed to. Why does this feel like this? I thought I did the right thing. So one reason the hidden risk we're going to talk about will come into play here. So first thing is the bad timing risk. The simplest way to say it is sometimes you have to pull money out of a down market because you just have to. So it's not the average return that's hurting retirees, it's being forced to pull money out when the market's down. When you're working and investing, a down market can feel like a long-term opportunity because you can add funds, you can buy more stock, and you have 5, 10, 15 years to be able to have that grow. But in retirement, you're taking withdrawals to pay for your life and your expenses. So if the market drops and you have to pull money out from investments, you might be selling at a discount. Then when the market recovers, you have less now to recover with. This is why timing matters so much in retirement. So the goal becomes, how do we avoid being forced to sell investments during a down market? So here is a backup plan. Let's picture two different retirees. They save the same and they spend the same. Let's just pretend they're pretty much the same, just two different human beings. One retiree gets a market drop early in retirement, and the other gets the market drop later in retirement. Even if the long-term average is similar, the one who gets the drop early often struggles more because withdrawals during the downturn can cause long-term damage. That's why I strongly recommend a retirement plan that doesn't only rely on one account, one 401k, one savings account, one investment account. It includes a backup plan so that you don't have to sell when the market's down. Now, for homeowners, this is where equity does matter. So, the hidden asset. Home equity is most often the largest asset that a retiree owns. But people often treat it like it's off limits, like it shouldn't be part of the conversation. I hear it all the time. I have to leave it for my kids. I don't want to touch it. And listen, I'm not saying you should use your home equity. I'm saying you should understand that your options include home equity before you need it, just as a backup plan. Because when retirees ignore their home equity completely, they sometimes put too much pressure on their investment accounts, especially in a down market. And pressure is what creates fear. So we're going to talk about home equity as a planning asset, not a panic button. So home equity. Simple explanation of home equity is the value of your home, the fair market value of your home today, what someone would buy it for, what an appraiser would tell you, minus any debt you owe on that house, which would be a lien, a mortgage, a home equity line. Whatever that difference is what you truly own. For many retirees, that's a big number, sometimes larger than what they have in their savings accounts. The key is this: home equity isn't spending money, it's reserve, and reserves create stability. That's the main thing. All right, so why does home equity matter in retirement? It matters because it can help you plan and protect for the rest of your life and your retirement plan, basically. It can reduce any monthly stress you have, especially if you still have a mortgage payment. We'll be able to extinguish that mortgage payment. It can cover surprise expenses like a roof, a large medical expense, insurance costs if you do have to change your Medicare plan, and it could help you avoid selling investments during a downturn. It can also help with longer term needs, like making the home safer or planning for care. I spent many years, long before mortgages, watching family face care needs with no plan. Most people don't plan for this. And I can tell you, your care needs can change fast. I've had people spend all of their money and come to me when they did basically spend everything and all that was left with was the house. I have seniors who are living in their home and they need to do renovations to make it accessible because they have a big house, they have 2 levels, they want to put in a stair lift. Home equity can be used to do these things. Or if you need an aid in the home and you don't want to pull out of your retirement and it's not covered by the VA or Medicare or any other type of long-term care, it's a good tool to use so you can leave those retirement funds exactly where they are. So I like to say, think of home equity as a safety valve or a spare tire. You don't have to wake up thinking, I hope I get to use my spare tire today, because nobody ever wants to use a spare tire. It's clunky, it's annoying, could be dangerous. But if something happens, you're totally grateful it's there because now you can get to your destination to get a new tire put on. In retirement, the flat tire might be a market drop could be inflation, or a sudden, unexpected health issue. And when those things happen, people don't need perfect answers. You really need options. That's what home equity can be, just a safety valve. Not something you use every day, not something you plan for, but something you understand and can implement when needed as an option. So, common ways to use home equity. There are several ways that you can access home equity. So, the first one is selling and downsizing. You may need to sell because your house is too big or it's not safe enough, and you're going to sell your house and use the proceeds to fund either care, buy a smaller home, go into an assisted living. That's one option, is to sell. So anything that you owe on the house minus any fees would be given to you as proceeds. Some use a home equity line or HELOC, home equity line of credit, but those typically come with monthly payments, and you do have to qualify. There's debt to income ratios involved in that. So some people in retirement would not qualify for a home equity line. Some people come to me looking to do like a cash out refinance. Depending on rates, that could increase your mortgage payment, even if you get to take cash out. And then there's the retirement mortgage, also known as the reverse mortgage. It is not the only option, but it's one option. It's worth understanding because for the right person, it can create flexibility and reduce pressure. It's really an amazing tool. So let's define it simple as we can. So a retirement mortgage, also known as a reverse mortgage, is a home loan for homeowners at 62 or older. It allows you to access part of your home equity in a structured way. That access might be set up as a line of credit, as monthly payments as income, or other options. The most important thing to understand is a retirement or reverse mortgage is a loan. It's not free, it's not taxable, but it is a loan on your home, just like a regular traditional mortgage. But when it's used the right way, it can be part of your retirement plan, especially if your goal is to reduce stress and to protect your investments during the down market. A lot of financial advisors are starting to take that three-legged stool financial plan and turn it into a chair, with the back of the chair becoming the home equity. So adding that into a plan is starting to happen more often, and also for my generation, Generation X and younger, we're going to be looking at home equity more for us to live on rather than to save as a inheritance for our children, for many different reasons. So let's compare the reverse to a traditional. So a traditional mortgage, you make payments every monthly. As you make the payments, you're paying down the principal, so your equity is growing. Now with a reverse mortgage, you're not required to make a monthly payment, okay? Not required to, but you can. You have to still pay property taxes, homeowners insurance, and you have to maintain the home. The loan balance will grow over time, so the loan's going to increase and your equity is going to decrease. But the way it's structured, you're not allowed to take out 100%, not even as much as you could with a traditional mortgage, so it's going to leave you with a lot of equity. Removing a mortgage payment can definitely help with cash flow, because now that $2,000 a month or whatever you're spending on a mortgage becomes $2,000 that you could use for your care, for your expenses, without having to pull out additional money from your 401k or increasing your required minimum distribution. It can also help retirees who want a backup plan so they don't have to sell investments. So we will talk about the rules. Okay. Now these rules apply pretty much to any mortgage or just being a homeowner in general. You have to keep everything current and in good standing. So as long as you take care of your home and keep the property taxes and insurance paid, that's good. There's 3 additional rules with the retirement mortgage. You have to be living in the home as a primary residence. This cannot be on a second home, vacation home, or investment property. You have to pay, like I said, your property taxes and your homeowners insurance. And then you have to maintain the home. You have to make the necessary repairs and keep it in good condition. A lot of people hear scary stories, and it's often because someone did not take care of one of these three things. I also want to make it clear that the rules are simple, and we're going to go over a little bit more as well. So, when is a retirement mortgage or reverse mortgage repaid? There's a few times when it's repaid. So it's typically repaid when the home is sold, when the last home buyer moves out, or when the last homeowner passes away. So it can become due if the basic obligations are met, like the property taxes or insurance. If the mortgage servicer or HUD find out that the taxes are overdue or the home doesn't have insurance, they can call the mortgage due, and that would have to be paid. If you sell the house, obviously, like any other mortgage, the reverse mortgage has to be paid. If you leave the home for more than 12 months, whether it's a facility or you have a second home, it may come due. When a home is owned by a married couple, when the last homeowner passes away, that's when it becomes due. So if one passes away, the other spouse can live in the home. So a lot of things I hear is, what am I leaving for family? What about my kids? And it doesn't mean that you're leaving your kids with a mess. There are options and a process, and they can still inherit the house if they want to, or the proceeds. Part of what I do is make sure that families understand how it works so nobody's surprised later. So let's connect this to the strategy. So first thing is to avoid a forced sell. And this would be forcing to sell your investments when the market's down. Some people also use this to delay Social Security. Social Security age has increased, so if you want to get the maximum, you might want to retire but not collect Social Security, so you can live off of your home equity for a while, and then you can pay it off at another time. So the backup plan includes usually cash reserves, planned income sources like a 401k, annuity, interest income. For homeowners, it might include these home equity tools like a retirement mortgage. And it's not magic. It's about building the options so you can make decisions ahead of time before it's rushed. Because when families are rushed and something unexpected comes up, that's when there's a lot of confusion, stress, and a lot of emotions involved. So I always say that retirement planning is a toolbox, not one single account. So first, we're always told we have to have a cash buffer, something liquid for short-term expenses and things we need on a regular basis. Income is what comes in each month. Your part-time job, your Social Security, your pension, your VA benefit, your required minimum distribution. Then there's also some tax strategies you can discuss with your CPA, like a Roth conversion. And then there's your home equity as a backup. This could be a reserve for unexpected needs or just to have ready. One of the features I like about a reverse mortgage is the growing line of credit, which a lot of people don't understand. So in your reverse mortgage, there is a line of credit. The line of credit, any money in there is going to grow at the same rate of interest as the loan amount. That can grow and be a reserve for you in the future, and you can take out as needed. Care planning, which in my experience over 25 years has been one of the most important things, from early diagnosis of Parkinson's, cancer, wheelchair-bound, bed-bound, dementia, Alzheimer's. These things unfortunately happen, and we don't want them to happen, and we don't usually plan for them to happen, but unfortunately, this is a huge, huge reason for you to consider your home equity as a backup plan for your retirement. So, like I said, working in elder law and Medicaid planning, I've seen a lot of this. Things happen in the blink of an eye. I've had a wife come in for her husband that had Lewy body dementia, and she passed away before he did. So we had to switch our plan. You never know what's going to happen. So we want to make sure that we have checked off all of these items in your toolbox. So let's talk about the myths. So myth by myth, I know this might be a little small, but I hear these same myths over and over and over again. So the first myth is the bank takes your home. They don't take your home. They don't want your home. As long as you keep up with your property taxes, your insurance, and keep your home in good repair, they have no reason to touch your home. When someone passes away, you definitely have to let them know, and that's why using someone that's a certified specialist to help you will keep in touch with you and tell you what to do in the future, not just now to get the product. My kids will be stuck with debt. This doesn't mean that you're leaving your kids with debt or a mess, but we have to put together the option, let your kids know what's going on, and give them a plan, just like here are my life insurance policies, here's my burial plot. All of that has to be set up for them so they know exactly what to do. You can't sell the house. Well, you can sell it anytime as long as that loan is paid off, just like any other mortgage. You can sell the house, pay off the reverse mortgage, and then take the proceeds and do what's needed with them. A reverse mortgage is only for people who are broke. Some people use the retirement mortgage as a planning tool, especially for flexibility, getting extra cash flow, protecting investments for a downturn, delaying Social Security like we discussed. Now, let me share why I care about this so much. So I spent 25 years before getting into mortgages helping seniors with asset protection, Medicaid planning, and care coordination. I have seen hundreds of times what happens when families don't have a plan and care needs hit quickly. And I've also worked with a family that used all of their assets, many families, to pay for care and ran out of $500,000 or more. So in some cases, what I did was help them with a retirement mortgage so that they can access equity so they can age in place. I'm a firm believer of aging in place. If you want to live in your home and you want to die in your home, you should have the right to do that. And using your home equity is one way to continue to do that. Accessing the home equity was able to supplement the insurance that they were already getting covering that care, and they were able to get more care and round-the-clock care. They were definitely relieved. Mom had the care that she needed around the clock. So this is what is important to me and keeps me preaching about this product and talking about this product, not pushing it, but it is a great tool. There's nothing to be afraid of. What you should be more afraid of is not being able to get the care that you need and you deserve. So here's a 3-step action plan. So step 1 is know your monthly numbers. Calculate how much you need every month to cover your expenses and your desired lifestyle. You want to play golf every week? Put that on there too. What does it cost to live life and have a little bit of cushion? Because you want to have that. You don't want to just struggle. You've worked your whole life. So step 2, identify your income. So determine what guaranteed income you get every month, which is your Social Security, your pensions, and your annuities that you can count on regardless of what the market condition is. Third step is the backup plan, which is where home equity comes into play. If the market drops and stays down, where does your spending come from the next six months to 2 years? And what I want you to remember is my home equity can be part of my plan. My home equity can be part of my plan. It's not for everyone. I don't recommend it for everyone, but it can be part of your plan not in every season. It's something to discuss, to know when you should have to trigger this. So if you want any help applying this to your situation, I recommend a quick review. Not selling anything. I just want to give you the options and give you education on what this would look like for you. So we'll go over those questions like in the last slide, where we're going to look at your expenses and your income and see what kind of home equity you have. We're going to I'll give you a high level view of what a reverse mortgage will look like to you and when it's possible that you may need to trigger this. And we can include family, friends, CPA, financial advisor. We can have them all in the meeting. I actually encourage that because we work together. I may know things that they don't and vice versa, and we may have to put our heads together to figure out what's going to be the best option for you. So in review, I'll map out your numbers, figure out your income, and we'll come up with a backup plan. Then we'll look at your home equity. So like I said, my job is just to give you the facts and the options so you can decide what's best for you and your family. If it's not completely okay, or it's not right now, or it's not a good fit, fine. I want you to be clear, and I want you to be able to understand what your options are. If anyone has any questions, we can address those questions. No questions too small. Someone probably has a question, I'm sure, somewhere in here. Okay, so if you need to reach me or you have any additional questions, this recording will be sent to you after today, within the next 48 hours. My name again is Michelle Albon. Here's my phone number, my email, and this is my website. And I truly, truly thank you for being here today and listening. And hopefully this gave you some insight on how to have a backup retirement plan, especially in a down market or when care needs exceed what you can afford. Thank you and have a wonderful day.